The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Sell the rumor, buy the news. For Netflix, we're going to find out in just about an hour. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Boston.
And I'm Scarlett Fu. We're kicking you off to the closing bell here in the U.S. U.S. stocks opened with a bang, and they've been losing some steam. The S&P 500 still holding on to a gain at the moment. We are seeing strength in semiconductor stocks. TSMC had a beat and raise quarter. There was a big sell-off in treasuries on better than expected data. The yield on the 10-year going up to almost 4.10%. And euro is weaker after the ECB cut rates for a second straight meeting. Romaine?
Yeah, and this could be a potentially big day, Scarlett, for big tech, if you will, with Netflix earnings set to stream across the Bloomberg terminal just about 1 hour from now. And while not quite a tech bellwether, given the company's narrow focus, Netflix results, they do often shape broader market sentiment for the days that follow. The big concern is that despite all of the changes and tweaks that Netflix has made to its business model, revenue growth is still slowing.
Subscriber growth has been strong, but at some point it's going to run out. They are going to hit a wall. And so I think investors and the company has to get ready for now that shift in the narrative. And the question is really going to be, where is the next leg of growth going to come from?
And full coverage of those Netflix earnings right here, right when they happen. So don't go anywhere. But before we get there, we do need to talk about the other big story, and that is the surprising strengthening in U.S. retail sales. A government data report that adds to the narrative of a resilient consumer and a Teflon economy that should be a positive for stocks. But for bonds and options traders betting on additional Fed cuts, it's for now a net negative. Treasury yields drifting higher for the first time this week. The dollar strengthening for a fourth straight session, and swaps contracts now pricing in fewer than 2 rate cuts over the FOMC's November and December meetings. And Scarlett, that's a huge about face from just a couple of weeks ago when people were a lot more aggressive and pricing in as many as 3 cuts before the end of the year.
Yeah, once upon a time, right? Well, we're also seeing a dramatic turn in the pricing of 2025 rate cuts as a no-landing narrative takes hold. About 5 weeks ago, the market anticipated 170 basis points of cuts next year. That's equivalent to almost 7 standard cuts across the FOMC's 8 meetings in 2025. Now, we're looking at something at around 100 basis points of reductions, or just 4 cuts of 25 basis points each. We'll be speaking with former New York Fed President Bill Dudley in the next hour to get his take.
All right, let's continue this conversation right now, kicking you off to the close on this Thursday afternoon with Stuart Kaiser, head of equity trading strategy over at Citi, joining us right now here in Studio 2. Stuart, great to have you here.
Good to be here. Thanks for having me.
Let's start off talking a little bit about the rally, and I am curious, the equity rally, but I am curious about some of the correlations with the moves that we're seeing in the equity market, at least prior to today, the lack of moves that we were seeing in the Treasury space, and kind of everything in between. Are there strong enough correlations there that we should be paying attention to?
Yeah, I think there are, and I think what we've seen, the last month or so is a little bit of imbalance in that relationship. At the beginning of the year, we had very positive U.S. growth surprises. Recession gets pushed out, rate cuts get pushed out, equities rally. Now we're in a position where, these rate cuts getting pushed out, I think have been just a little more disruptive because the market is kind of in transition phase, number one. And number two, you had so many cuts priced in that it's become just a little bit of an issue from a bond volatility perspective.
I am curious, though, and this is always sort of a kind of an academic discussion. When you start to see data like we saw today, that seems to ratify this idea that people, at least a certain cohort of people, are still spending. You have an economy, at least GDP growth, that is still at what would in the past would have been considered pretty healthy. I know in this day and age we think it's meager. Why won't stocks rally more on that? Because even if you don't get all of the rate cuts priced in, you still have a backdrop that I would think would be supportive of the main driver of stocks, which are corporate earnings.
No, I agree with that 100%. I mean, we do think the data you've gotten over the last 2 to 4 weeks is undoubtedly positive for equity markets. Unfortunately, you have a couple big, a series of event risks here. You have, payrolls on November 1st, then the election, then the FOMC in a tight cluster. So I think that combination is just making people a little bit hesitant to put risk on, despite, strong underlying data in the background. And I think the second part is, a month ago, we were talking about concerns of a slowing economy. So you have had this little burst of positive data, but I think the memory of that slowing data is also kind of hanging on a little bit for people.
Yeah, so as you say, a transition in the narrative, but people are still adjusting to the new mindset. You mentioned the event risks that are coming up, whether it's the jobs report, election day, or the FOMC. If you put a number to it, what does volatility events look like for those three things?
Yeah, I think election is what people are most focused on right now. And there's a little bit more than a 2% move priced in for the S&P, almost 4% for small cap for the IWM. And I think most importantly, from a rates perspective, about 15 basis point move in the 10-year yield priced in as well. So, those sound like large moves until you look at what's happened the last month and you see that, these things have sort of, happened on a given day here and there. So the election is priced as the biggest event. And then I would say FOMC and payrolls still very important, but it's hard to kind of, be a bigger event than the election right now.
So when you look at the election themes that, are out there, even if it's too early for people to really position for them, you've picked up a couple of areas that you're really paying attention to: small caps, banks, and energy. Of those three, which is overplayed?
Overplayed, I mean, it sort of depends on what happens. I mean, at a 50-50 event, it's a little hard to know. I would say the bank side of it is what's gotten the most attention recently, and that's partially an election trade, and it's partially that we just went through earnings in the bank sector. So that feels like the area that's moved the most and where sentiment has improved the most. Again, it's not all elections. Some of that's fundamental, but that certainly seems like the one that's moved the most. If you take something like taxes, it actually feels like the space between the policies of the two parties isn't really as wide as it has been in the past. So I think that one's taken a little bit of a back seat. But banks for sure is where we've heard the most incoming from clients.
When you look at the, I guess, slight rotation, let's just call it for now, that we've seen into some of the kind of material stocks, cyclical stocks, kind of real economy, if you will, here, do you see a little bit left in that trade, or a lot left in that trade?
Yeah, I think there's definitely still space there once we get through the election. Just because, as I mentioned, a month or so ago, we were worried about this becoming a hard landing and not a soft landing. And if the data does prove out that this looks like a soft landing or solid economy, then I think there's room for that stuff to catch up, whether it's materials or capital goods or some of the more cyclical parts of the economy. Small cap's a little tricky just because of the credit risk, but certainly if there's any part of the market that's well set up for a soft landing plus insurance cuts with potential deregulation, depending on who wins the election, it is small cap that's best positioned.
And so just to be clear, your house view over there at Citi is for the soft landing, or at least some semblance of a soft landing?
I'd say up in the air. Our economists are actually pretty conservative about what economic growth is going to look like in the fourth quarter. I would say the plurality of investor views is probably for a soft landing. So as a markets guy, I kind of get caught between those two things. And we just read and react to the data. And what the data is telling us right now is it's looking more like a soft landing than it is like a hard landing.
Tell the truth. Who's smarter, the economists or the markets people?
Oh, the economists. The economists for sure. The economists for sure. We're just chimpanzees throwing darts down on the trading floor.
What does the data tell you about what's going on in the semiconductor industry? Because we've had kind of a whiplashy week, right, with ASML and now TSMC, and NVIDIA doesn't report until the end of the earnings cycle. Yeah,
I think what it tells you is that theme is I think receiving a little more critical analysis probably now than it had during the previous year, and I think that started last quarter, which is, you've achieved levels of growth and levels of revenue that are going to be hard to surprise to the upside. You also saw a little bit of I don't know if I call it a wobble, or maybe just a little more rationality in discussions of the CapEx spending cycle out of a lot of those hyperscalers and big CapEx spenders like Microsoft and Meta, et cetera. And look, it's a circle, right? Those guys spend on the stuff NVIDIA sells. So if you start to get a little bit concerned about what is the rate of growth of that CapEx, it means the bar, I think, on the NVIDIA side got set a little bit higher last quarter. So I think that's what it's telling you here is, this theme is, it's not long in the tooth, but this theme is very well understood, and the level of critical analysis going into every data point is much higher, and that's I think why you're seeing these whips back and forth.
All right, Stuart, got to leave it there. Stuart Kaiser, head of equity trading and one of the smartest guys over at Citi, kicking us off to the close here on this Thursday afternoon. Financial stocks out in front again, including regional banks. Huntington Bank shares, though, sitting it out. They reported earnings earlier, and there are some concerns here about how regional banks are still contending with somewhat tepid loan growth. The conversation up ahead with the CFO, Zach Wasserman.
Plus, Embraer is jet set for growth, how the aviation giant plans to take its facilities in Fort Worth, Texas to new heights with a $70 million investment.
And as everyone sort of focuses on the Fed and what they may do next, a lot of criticisms as to the data dependency and whether, well, it's a little bit too much in the rearview mirror. A conversation with former New York Fed President Bill Dudley coming up in just a second, right here on The Close on Bloomberg.
We're looking at shares of Huntington Bank down right now, snapping a 9-day rally after reporting earnings earlier today. The bank reported total deposits for the third quarter that beat analyst estimates, but EPS just missed the consensus. Joining us now to discuss is Zach Wasserman. He is Huntington Bancshares Senior Executive Vice President and Chief Financial Officer. Zach, thank you for joining with us today. You are clearly differentiating yourself from other regional banks. You've got strong balance sheet growth, not just in loans, but also deposits. Explain to us briefly how you're accomplishing this when the rest of the industry, your peers, aren't seeing that kind of growth. It's a lot more muted for them.
Extraordinary. We just had the chance to report our results today. We posted 6% annualized growth in loans in the third quarter. I just had the opportunity to review the other 7 large regional banks in and around Huntington size, and only one other one posted growth this quarter, and it was just 0.1%. So we're really performing in a very differentiated way. You know, for Huntington this year, it's all been about acceleration of lending and really driving growth both from our core business and from a number of new initiatives, launching into 3 new states, launching a number of new corporate businesses, and they're really starting to build some momentum.
And also on the revenue side, one highlight for last quarter is fee strength, which is lifting both revenue and profit overall. Tell us a little bit about where you're collecting these fees and how much pricing power you have in these businesses to keep increasing those fees.
Yeah, it's been one of our most important areas of strategic focus, building the value-added fee businesses, in particular for us, payments, wealth management, and capital markets. We saw, as you said, 12% year-over-year growth in those. And if you unpack it, you know, in the payments business, we're seeing treasury management 8% higher year-on-year, wealth management 18% higher revenue growth, and then in capital markets was really strong, 50% higher year-on-year. And you know, for us, it's mainly about building capabilities and introducing those products to our customers more effectively, and we're seeing, you know, nice market traction that we expect to continue.
Hey, I am curious, Zach, here, particularly about the commercial banking side of the business, and a focus on the middle market loans. Whether you've seen a meaningful uptick in that business coming into the bank, or whether there's still a meaningful amount of competition coming from outside of the banking space.
Certainly, there's no shortage of competition, both from the traditional commercial banking sector and more, as is widely reported, you know, private credit penetrating different elements of the business. With that being said, what we're seeing is a lot of receptivity to our approach, which is very locally focused, very much bringing expertise, but with a focus on locally executing. To give you a sense, our regional banking business that focuses on small business customers and the smaller end of middle market has posted record production in the third quarter, and in September we're seeing double-digit growth in lending there, and yet again another number one small business administration SBA loan production market share for Huntington. So we're seeing good demand. It's maybe it's just a function of how well we're executing, but certainly also an indication that the economy remains relatively strong for those borrowers.
You have definitely a very regional focus. You're headquartered there in Ohio and some of the other states that you operate in. Talk to me a little bit about the economic activity that you're able to see from your vantage point as CFO of a major bank as to what you're seeing in terms of economic activity in those pockets.
You know, what we're seeing broadly is continued economic growth. It tends to corroborate the narrative around, you know, achieving a soft landing here, achieving maybe, you know, continued economic growth, whether you want to call it no landing or soft landing, but a continuation of economic growth. Certainly, we've seen on the consumer side a slowdown of activity, but still growth. And on the commercial side, I think one of the biggest things that the last 3 months have borne is a stronger conviction on the part of borrowers that interest rates have peaked and are going to come down. And so I think that has helped to catalyze decision-making on new growth, new expansionary investments, and we're certainly seeing that come through. As I mentioned, a pretty notable acceleration of lending in the third quarter, double the growth rate that we saw in the second quarter as an indication, and I think very much a function of that conviction around where the market and the path of interest rates is going.
You mentioned a slowdown in activity, but not necessarily a deterioration. You provision less, and your net charge-offs were fairly stable, 0.3% of average loans. Do you expect this trend to continue this quarter and in the first half of next year, or will rate cuts provide a meaningful boost to all of that?
The outlook for credit quality.
Excuse me.
Yeah, no, it's a great question. And the outlook for credit quality is very stable at this point. For us, we've seen virtually the same amount of charge-offs every quarter for the last 4 quarters. And we've actually seen delinquencies going down. In the near term, we expect pretty much the same into the fourth quarter, very stable. And the outlook for 2025 is pretty good. We see continued performance, strong, relatively low charge-offs. And if that continues, the opportunity to continue to reduce credit reserves gradually over time as well. So the quality of the loan portfolio looks really good, and again, I think is a nice harbinger of a fairly solid economic environment, notwithstanding certainly some uncertainty that remains.
All right, Zach, got to leave it there. Appreciate you taking the time for us. Zach Wasserman is Chief Financial Officer over at Huntington National Bank, fresh off of their earnings earlier in the day. And I got to admire his commitment to the color scheme of the company there here, man. That's the guy you want to keep around.
Yeah, he looks pretty sharp out there, I have to agree.
Absolutely, yeah, I know.
It's another banner quarter for a bank. I mean, they've all been coming in better than expected.
Yeah, and I guess that's good. I mean, that's what we want to hear, right? Is that kind of the underpinnings of effectively of our economy are actually doing well. And I'm always curious to see what they think about the economy and economic conditions. And if he's not worried, then I guess maybe we shouldn't be worried.
Well, we'll see, at least for now, right? It changes minute by minute.
All right, so no worries on the banking front. We're going to see if there's some worries maybe on the streaming front. We're going to get Netflix earnings a little bit later tonight. And with the new season of Bridgerton and the promise of a Squid Game Season 2, will that be enough to boost subscriber growth? A preview up ahead in our top calls. This is The Close on Bloomberg. All right, let's get a view from the sell side with our top calls, the big movers on the back of analyst recommendations. And we start off today with SolarEdge, a downgrade to sell. This over at Guggenheim, with Chinese energy suppliers making their presence more known in European residential markets, to which SolarEdge seems to have no answer. At least that's according to Guggenheim, which is also concerned about liquidity and says SolarEdge needs to raise more money before September of next year. The share is down 4.5%. Next up, let's take a look at Eat, Brinker, the restaurant company, the owner of Chili's and Maggiano's Little Italy, hit with a market perform rating over at Raymond James. This is mostly a valuation-based call, with the analyst saying he's still bullish on overall performance for the restaurant chain, but says his positive view of comp sales and margin potential is already largely reflected in the stock after more than doubling so far this year. The share is down about 1.5% today. And finally, Uber, losing its outperform rating over at Daiwa, which cut its recommendation to neutral. Shares of the ride-hailing company have outperformed in the wake of Tesla's robo-taxi event, but the analyst says this leaves limited upside to Uber's valuation as to where it stands now, and it creates potential for pricing risks as robo-taxis try to increase frequency. Shares of Uber down about 2% on the day. And those are some of our top calls. Let's get now to what is going to be the headline of the 4 p.m. hour. 4 p.m. New York time. We are expected to get those results out of Netflix, and investors, as always, are watching out for subscriber growth. They're also watching for trends in the streaming platform's advertising strategy. Tim Nollen is a senior media tech analyst at Macquarie. He has an outperform rating on the shares, and he joins us now here in Studio 2. All right, Tim, I know they don't want us to care about subscriber growth. What are your expectations for subscriber growth?
Well, it's a Q3, which is, generally a slowish period over the summertime. And then you get maybe some subs as people kind of head back indoors into September. I think the consensus number is around 4 million subscriber adds for the quarter, which would be a bit of a slowdown, but that's probably to be expected. It's over a year now since Netflix started enforcing password sharing in the U.S. They very recently instituted, or they took away the lowest price paid tier plan for the U.S. subscribers. Yeah. All as a means, I think, of trying to get people to take on the advertising tier. So the most interesting question, I think, coming out of the quarter will be, how is the progress towards building up the advertising tier? They won't give us ad tier subscriber numbers, but this is really the question that we're all starting to wonder more. How
are we going to sort of gauge that? And when you take a look at revenue numbers, overall headline revenue numbers, is there any way to sort of parse how much of a boost they are getting from these new ad tiers?
Yeah, it won't be quite so clear from the beginning. From now, it's still kind of early days. Yeah. It might take a year or two still. I think they've kind of indicated this last quarter. It would take maybe up to a couple of years till we're really in kind of full run rate with generating good ad revenues. It's only now this fall that Netflix has begun doing some good work with ad tech companies like The Trade Desk and Magnite, and that really should help them better monetize their advertising inventory. But it takes time to build, the data and the technology links, the relationships, as well as building a large enough base of subscribers that is appealing to advertisers that want to buy ads on Netflix versus so many of their options.
Yeah, so if Netflix is going to turn everyone's attention to the revenue line, one thing that people definitely be on the watch out for is whether it increases prices for subscribers in the U.S. Is the goal here to push more people to the ad-supported tier?
In my opinion, yes. Netflix says that they want to kind of strike a balance where they're indifferent as to whether the subscriber takes the ad-free tier or the ad tier. Now, they can make more money off of advertising subscribers as long as they are generating enough advertising revenue. It's quite a different price point now between the ad tier and the higher priced ad-free tiers. I think what they really should be doing is really trying to push that advertising base. They want as many people on that ad tier as possible. That is audience, that is reach that advertisers are always looking for. And then they can be better about monetizing that using data, using technology.
And is that uniform across all the geographies as well? I mean, that might be the case in North America, but does it work in other geographies internationally?
Yeah, they are in, I believe, 12 markets with an advertising tier. By far, U.S. and Canada is by far the largest.
And most valuable.
Most valuable. Largest ad market, of course, globally by a long, long, long way. So that's where they're focusing the most of their attention. Impressive, by the way, that they are actually focusing on that from the beginning, not just doing a little test market somewhere else, but they're going right for the big market.
So this is all well and good, but the advertising business as a whole tends to be very up and down. And I am curious as to how they insulate themselves from those ebbs and flows where advertising might peak and then a year later it drops off and then they're in a bind.
True. They will be more exposed to that going forward, won't
Have they articulated any sort of way that they're going to try to blunt that, or is that just not a concern?
I would think for the next few years, it's really about structural growth for them, just building out a base and trying to grow into this market. You also have a very positive trend in Netflix's favor of the decline of linear TV. Doesn't mean people are watching less TV, they're watching more streaming TV. Netflix is the leader in streaming TV, so more and more ad dollars are flowing toward streaming TV. And it's not a simple matter of cutting off one and turning on the other. It's actually quite a complicated process for advertisers, as well as for the network groups that are selling ads. Netflix is in a nice position because it does not have that legacy network TV business, but they still don't have a history selling advertising. So they have to learn the ropes. They have to build a technology and a data resource to do that. So they're on the right track. They're doing the right things. It takes time to build. I'm hoping we're going to learn in a half hour or so what the progress is.
All right, good stuff. Tim Nollen over at Macquarie, thank you so much. He said it's not that easy to just turn off for the advertisers and go to another platform, but it's easy for consumers to switch out of Netflix and sign up for HBO, for instance.
Yeah, or if you're like me, you just subscribe to everything and burn all your money.
And don't watch it either, right?
Well, I have other people in my household who watch it, but I don't really watch Netflix anymore.
I know, you don't watch other TV.
I don't, no. And when we do turn it on, I mean, Max probably gets the most play in our house than of all the streaming networks that we have.
Yeah, well, your documentaries kind of got
that and Bloomberg Plus.
Without a doubt. All right, coming up, Brazilian plane maker Embraer is expanding its presence in the U.S. We'll speak with the president and CEO next. This is The Close.
Just about 3:30 p.m. here in New York. This is the countdown to The Close. I'm Romaine Bostick.
And I'm Scarlett Fu. And it feels like it's been a while since you, Alex, and me were all here at the same time, in part because so many of us are traveling.
Yeah, we're always kind of going somewhere, and I think we all come back and we commiserate about how bad our flight experiences were. But it's not really just the planes themselves, though. I heard the last time you flew, you had a little trouble with your seat.
On a red-eye flight. That was awful. Don't remind me.
All right, well, we're going to talk to Delta or whoever. Where were you on? Delta?
Delta, yeah.
Okay, I'll give them a call
Thank
for you. I'm actually flying on them next week. But the other thing also is the airport experience, too. Yeah. And we talk a lot about that. I mean, if you're here in New York, they've done huge work at LaGuardia and JFK, which are the two big airports. The third big airport in this area is out in New Jersey. Newark Airport.
Yeah, it leaves a lot to be desired.
They got some issues.
They do.
So,
but, they are embarking on a major overhaul.
Yeah.
No cost estimate yet, but it's going to span 4 decades, which just gives you a sense of how much construction is going to be there permanently. That's, of course, an artist's rendering.
That's a rendering. Okay.
Yeah, that's
well,
not
it looks,
reality yet.
Okay, well, I would take that over what's currently there right now. And, of course, at the end of the day, though, that brings us also back to what's on the ground, and that's the airplanes, too. And, I remember we were taking with Tim Senevic. He was talking about how he actually looks to see which airplane is on. Is it a Boeing? Is it Airbus? Or maybe Embraer?
Yeah, well, let's talk about Embraer, right? It's the Brazilian plane maker, and it is expanding its manufacturing presence here in the U.S. The company says it'll invest up to $70 million towards a Fort Worth, Texas airport by the first quarter of next year. And this is part of an effort to support its growing fleet of E-jets in the U.S. So here now in studio for more on the company's initiatives is President and CEO Francisco Gomes Neto. Welcome to Bloomberg.
Thank you very much. Happy to be here with you.
Thank you again. So I want to talk to you a little bit about some of your initiatives. I mentioned E-jets, and of course, we can't talk about manufacturing without bringing up automation as well. And I'm curious how much Embraer has invested in automation for your aerospace manufacturing operations. And I'm in particular wondering about how difficult it is to incorporate that in aerospace in particular.
Well, actually, we do both. We invest in the lean manufacturing combined with automation. We want to remove the waste of the process at the same time to automatize the process. And we're doing very well. We have improved a lot of the efficiency of our operations in general.
Okay, so we talked about E-jets. I'm also curious about the products that you do have right now and whether you would look to perhaps develop a narrow-body jet to compete with Airbus and Boeing. There's a shortage of airplanes around the world right now.
Well, we have a very young portfolio of products. Launched in 2018, 2019, so that our focus now is really to sell the products we have, to amortize the investments we have made, and we are making studies for a new product, but we don't have any concrete plans yet.
With regards to your existing lineup and your existing customer base, where are you seeing the most demand in terms of airlines, or at least regionally?
Well, U.S. is our main market. We have been here for 45 years. We have a production site in Melbourne for executive jets, and we announced this week a new investment to expand our service for commercial jets. So U.S. For sure is one of the main focus markets for us.
What's the market looking like right now for executive jets, business jets, if you will? Is there still healthy demand?
It is. It's going very well. We have a great portfolio of products. We are sold out almost until the end of 2026 and investing to increase our production in Melbourne, Florida.
I want to talk about supply chain issues. There's been some hiccups there, and I'm wondering if you are seeing any kind of knock-on effects from the issues that Boeing in particular is facing. What does it look like on your end?
Well, the supply chain is improving year after year, but we still with some bottlenecks. Because also we are ramping up production year after year since 2022. So again, we have some specific issues, specific problems that we have been working very closely with our suppliers to resolve them.
Is there room to consolidate? Would you consider making acquisitions to vertically integrate your supply chain?
Well, we don't see this. We really are just working very close to our suppliers, to make sure that we get the parts we need on time.
You have a good relationship with those suppliers, enough faith, enough trust in them?
Very good relationship. This, I think, is one of the differentials of Embraer. We really treat our suppliers in a very positive way, and in order to come together with the solutions good for both.
When you look at the history of Embraer and really look at the history of all of the big commercial plane makers that exist today, there are a lot of people that think we could be moving to a different era of air travel. We mentioned E-jets, of course. There are ways to make airline travel more energy efficient, if you will. What is the next big thing for this industry as you see it? Well,
our new commercial jet generation, the E2, are the most efficient single-aisle aircraft in the market. It's 25% less fuel burn compared to the previous generation. I think this is a great step in the direction to reduce the carbon emissions.
What about business jets? What's your outlook for business jets right now? I'm curious what demand looks like given that interest rates are falling and it's cheaper now to borrow.
Well, we are very positive with the development of the business jet market for Embraer. So we are growing a lot from last year to this year, production deliveries. We have plans to continue growing in 25 and the years ahead.
Okay, and a final question here on Boeing. I know that you, Embraer and Boeing had a somewhat bitter breakup in 2020 after Boeing scrapped the JV. How relieved are you that it didn't go through, given what Boeing's going through right now?
Well, the termination of the deal with us was a Boeing decision, but since then, we have made our plans to go ahead alone, and we're doing very well. We are in the best moment of the company.
Would you consider partnering up with them again, do you think?
We are open to partnerships in the future.
Yeah.
I mean, since they help us to open new markets for our products.
All right. Really appreciate you taking time for us, Francisco, today. Thank you.
Oh, thank you. Thank you.
Francisco Gomes Neto, he's the president and CEO of the commercial jet builder Embraer here. And as we keep an eye on the aviation space, Scarlett, there was actually what I thought was a pretty interesting story that came out earlier today about Expedia. This is, of course, the travel booking site. Mm-hmm. And apparently Uber, according to people familiar with the situation, had actually considered potentially buying the travel platform. Did you hear about this?
Well, there is a person in common here, right?
Yes.
Kaiser Shahi.
Yes.
He led Expedia for 12 years before he moved over to Uber. So he knows that company pretty well. Yeah,
I thought this would be an interesting time. I mean, I guess, the Uber sees itself as a transportation company. So I guess Expedia, travel, why not here? I think it caught a lot of people off guard, though. I mean, you saw Expedia shares kind of rally on this. Uber shares kind of dropped here. But you do kind of wonder if maybe we are going to see a future where a lot of these sort of disparate travel, transportation type companies maybe find a way to join forces.
I mean, I think there's going to be a lot of reporting on all these different kinds of tie-ups and what could have been or what could be, provided there's a change in the administration and perhaps a certain person isn't at the FTC.
I don't know who you're talking about, Scarlett Fu. All right, when we come back, we're going to take a closer look at economic policy, and we're going to take a closer look, really, at all of the pontificating about what the Fed does next. That meeting-by-meeting decision-making process that Jay Powell seems to love, it might be creating unnecessary volatility. A conversation up ahead with Bill Dudley, former New York Fed president, and of course, Bloomberg opinion columnist. That's coming up next on The Close on Bloomberg. Thank you. All right, one of the most read stories on the Bloomberg terminal today is about Fed Chair Jay Powell, who has made it clear that the Fed's interest rate decisions will be made on a meeting-by-meeting basis. But by carrying on this way for an extended period, investors and economists, some we should say, are now criticizing that approach, saying that data dependence creates volatility, given that most economic data is way too backward-looking. Let's bring in William Dudley into this conversation. He's the former New York Fed president, former vice chair of the FOMC, and now a Bloomberg opinion columnist. He obviously knows about the inner workings of this agency and, more importantly, about the data that they're dependent on. I don't know what the solution to this, Bill. I know there's a lot of real-time data, if you will, that comes out now that we maybe didn't have in the past. But is there some advantage that Powell and company would have in weighting that a little bit more heavily than the backward-looking data?
I think they do weight the data that's more readily available. I mean, at every FOMC meeting, people report on the contacts that they've had recently with people in the business world. So it's not just the economic relief data from the federal government. There's also a lot of anecdotal data that helps fill out the picture. I think the problem is just one of the fact that to know what to do, you have to know what reality is, and it takes time to translate from economic releases to what's actually happening in the economy. And the data is noisy. It bounces around month to month. It's subject to seasonal adjustment problems. It gets hit by shocks like the weather, the hurricanes, strikes. And so knowing exactly where you are at any particular point in time is very difficult. Another problem the Fed has, frankly, is they also have this fundamental problem of trying to assess the current stance of monetary policy. How restrictive is it? Yeah. They think it's quite restrictive right now, but the economy is continuing to gallop along. The Atlanta Fed raised their GDP now forecast to 3.4% for the current quarter. So that's not an economy that looks like monetary restraint is restraining very much at this point.
Well, that gets to a question, too. And I don't ever want to sort of minimize just how difficult this job is. I mean, we're armchair quarterbacks here, so we always think that we know more than what's going on behind the scenes. But a sort of an undercurrent, though, of the criticism is this idea that the market wants the Fed to maybe be a little bit more articulate or, if not aggressive, in saying where they think the economy is going. And I know we get the dot plots, but they're hungry for something a little bit more. And asking you as to whether you see any value, any true upside on a net basis for Powell to do that.
Well, I think the problem here is that the Fed's crystal ball in terms of economic forecasting is not much better than the crystal ball of everybody else. And you can see that by looking back at the summary of economic projections at other points in time. Those summary of economic projections have been often turned out to be very wrong with the benefit of hindsight. I mean, the Fed did not forecast a big surge in inflation. The Fed was pretty late to raising interest rates this cycle. So I think the Fed's reaction function is pretty clear. There's how would the Fed react to a given set of economic information? The Fed, I think, made that very clear. You can see that in the summary of economic projections. You can tie their economic forecast with what they would actually do in terms of interest rates. Mm-hmm. What isn't very clear is how the economy is actually going to evolve. And it's that uncertainty about the economy that's magnified by the noise in the economic releases themselves that make it very difficult for the Fed to, plot things out more than a meeting or two in the future.
You had said the data is noisy, but being data dependent means relying on each data point. So I feel like the anecdotal becomes more important. It's something that the Fed officials are certainly paying a lot of attention to. Should we be paying more attention to things like the Beige Book?
I think what you want to do is you want to treat the data in its entirety. I always tell people that it's like an impressionist painting. You don't focus on one dot. You focus on the totality of all the dots. Each little piece of economic data represents a dot, and you sort of need to stand back from the painting to really get a sense of what's really going on. So I think the markets at times, overreact to the last piece of economic information, not recognizing that the information that's being released by the governments are just estimates. They're surveys. They're doing a survey, and this is what the survey results come back. Mm-hmm. Just like a political poll survey, plus and minus, errors, survey errors. And it's even worse for the economic news because, the weather changes, economic conditions change, there's strikes, there's all sorts of shocks to the economy that distort the data that's released relative to what's actually happening.
Yeah, there feels like there's a lot of contradictions going on right now in this current economy. You have tight monetary policy even after that supersized cut, but you also have a loosening of financial conditions over the past year. Why do you have this tension here?
Well, financial conditions have loosened a lot because people are anticipating that the Fed is going to cut rates a lot over the next year. So obviously, if the Fed doesn't do that, financial conditions will tighten quite a lot. And we've actually seen a little bit of tightening of financial conditions in terms of the bond market and mortgage rates over the last few weeks, as the market went from expecting short-term interest rates to decline below 3% to now more in the 3.25%, 3.5% range. So right now, the market is where it is in terms of financial conditions because of the expectations that the Fed is going to cut interest rates a lot. If the Fed doesn't do that, then financial conditions will have to adjust.
I am curious, Bill. I do want to just shift gears a little bit here and just kind of talk about what the Fed's job is going to look like when we get to January. We're going to have a new administration one way or another. There's been a lot of discussion about deficits. There's been a lot of discussion about tariffs. There's been a lot of discussion about whether the dollar will weaken or strengthen. These are all things now that Powell is going to have to factor in to his monetary policy decisions beyond just the economic data.
Well, I think the House and Senate are probably going to be very closely divided, so that will restrict the room for maneuver of any incoming president. But I think the one area that I think that's really important from the Fed's perspective is Trump versus Harris on tariffs. Candidate Trump has basically said he wants to do a 10 to 20% across-the-board tariff plus a 60% tariff on China. This would be far greater than what he did during his first term in office. And I think, economists believe this would be pretty terrible for the economy. It would basically drive up inflation and hold down growth by reducing productivity. Voters don't seem to think that. There was a poll by Reuters in September, which actually had something like 56% of the voters thought that doing what Trump was proposing would be a good thing. I'm an economist. I side with the economists. Yeah. There was an interesting a poll by the Booth School, University of Chicago Business School, and they found 95% of economists agreed or strongly agreed with the statement that if Trump did what he wanted to do in terms of his proposals, that this would actually be passed through and result in higher prices for consumers. So economists are pretty united on this, and the University of Chicago is not a left-wing institution. This is something. So this is not a left-right kind of issue. Economists are pretty united that higher tariffs result in higher prices that consumers in the U.S. would actually have to bear.
Yeah, and this is something our John Micklethwaite, editor-in-chief of Bloomberg, had pointed out to Donald Trump when they spoke earlier this week at the Economic Club of Chicago. Bill, really appreciate your time with us. Bill Dudley is a former New York Fed president and a columnist for Bloomberg Opinion. We are about 11 minutes away from the close of trading, so I just wanted to give you an update on where things stand right now. And the real action is actually in treasuries, not so much in equities, which is flat at the moment. You have a big move up in yields. It's come down a little bit, but 4.08%, better than expected data remain on retail sales and jobless claims, triggering a big sell-off. Yeah, you saw that sell-off there, and it gets to this whole seesaw that I think now the bond market and a lot of options traders are trying to sort of reconcile with as they try to sort of parse where yields are going to go next. I feel like this is just the range we're going to be stuck in for a while. It does feel like that. Right around there. And then you had a lot of dollar strength, too. I mean, like was a fourth or fifth straight day of strength in the dollar here, and that's complicating matters as well. Absolutely. Just one area of strength that we are seeing in the market in equities is chip makers. They've had a volatile week. TSMC's beat and raised, lifting the group today. ASML, of course, giving a dour outlook. So kind of which one do you give more weight to? I don't know. NVIDIA. All right. Here with more insight on the market overall is Jan van Eck. He is Chief Executive Officer with Eck Associates. Jan, talk a little bit about how big tech is maybe distorting our sense of where the market is and how resilient it is because of these swinging forecasts we're getting from ASML to TSMC. Yeah. Well, I think it's interesting because, when we met several months ago, I said, look, NVIDIA is a great company, but a horrible stock. And actually, in the third quarter, the NASDAQ underperformed, sort of a value-based equity strategy by about 12%. So that was right. I still feel like it's trading sideways, even though the business reports great numbers and Jensen Huang gives great interviews. And you look at the rest of the kind of big Mag 7 or whatever they are, and they just don't look that great to me. So the diversification trade is on. One hot area of the market, and if it's okay if I go there, is nuclear. Oh yeah, we've been talking about it. And nuclear has now become a derivative of large cap tech. And there's so many things going on. First of all, they've been funding some of these small nuclear reactors. There's been deals by Google, Amazon, Microsoft to basically, because they need power, they're extremely power hungry. And what's different about the nuclear industry compared to several years ago was the utilities had to pay for everything, and these plants were really expensive. Now, through the IRA, the government has come in, and now the big tech, so to the rescue for the nuclear industry. Well, that's what's interesting about this, and I hate to be kind of the Debbie Downer, but when we talk about people trying to broaden out this rally or diversify, you use an interesting word. This is kind of a derivative of that tech AI trade. That's good for now. Is there any worry here, though, if we do see cracks like we saw from ASML, or maybe that feeds into an NVIDIA or something else, that then will hurt this big move that we've seen into nuclear stocks and utilities and power companies, et cetera? Well, the nuclear, so much has happened in the last, week or month. There's some stocks up 40% in the last week. So, I think it's caught up to reality. I live in Westchester County, and they shut down Indian Point nuclear reactor in 21. So I thought nuclear was dead. Like I myself was not paying attention, even though we launched this ETF in 2007, so our first year in the ETF business. So the world has really changed. It's a bipartisan consensus. Most countries, except for maybe Australia, are now ramping up their nuclear. So there's a lot going on. But to your point, I think the stocks have kind of, they've priced in a lot of good news at this point. How much spillover do you think there is from the U.S. to China or China to the U.S., given that both countries are trying to stimulate their economy through rate cuts? Yeah, it's what I kind of say is don't worry about the headlines of the Mideast and everything, because you have the two largest economies in the world using their monetary power to stimulate their economies. Now, I kind of say I think it's like a light breeze. It's not a gale of QE that's going to be helping their economies. I think the U.S. is going to be challenged by a cut in fiscal spending next year. I've been talking about this, the 2025 fiscal reckoning.
And I think that's going to have a lot of flow-through effects on slowing the economy. And to your earlier interview, I really think the Fed has an eye on what Congress is going to do, because I think a Republican Senate is not going to have the checkbook out for either presidential candidate.
All right, Jan, we have to leave it there. Jan van Eck, he's the Chief Executive Officer over at Van Eck Associates, as we continue to count you down to those closing bells. Just about 6.5 minutes to go till those bells, and about 6.5 minutes to go until we get results out of Netflix. Let's get some insights right now out of Keith Gangl, joining us right now, Portfolio Manager over at Gradient Investments. A lot of high expectations, I think, Keith, for this particular earnings report, though we should point out Netflix actually down for a 5th straight day. And this is the first time I can recall that we've headed into a Netflix earnings report where we didn't see a little bit more investor enthusiasm.
Yeah, we'll see. I mean, expectations will be really high right now. Stock's been wonderful, to start this year, all of last year as well. So I think people are a little cautious again, but the bar is high, and I think that's why the stock's kind of selling off here prior to the quarter. So we'll see. The thing to focus on here will be the net ads. This is, they're only seeing net ads for this quarter and next quarter, and then stop reporting it for 2025. So street expectations are around 4.4 million. The buy side expectation, kind of the whisper numbers, around 6.5 million. So that'll be a key number. That, and we hear more color on what's going on with the advertising tier.
That is a big difference, a big gap between the consensus number and the whisper number, 4.5 and 6.5 million. We always talk about Netflix, or at least we do, about how it's kind of the kickoff to the tech earnings season. How much does Netflix's results affect sentiment towards the other Mag 7 names, Mag 6 names at this point?
Yeah, a little bit. Obviously, I think it used to be one. It was a FANG acronym. It was, the Netflix in there. It's not in the Magnificent Seven, but it will impact them. So it is a kickoff, but it's a little bit different, right? It's a little more consumer facing, where, generally speaking, the Magnificent Seven are all tech related. So it's a key number tonight, and we'll see. Again, I don't mind this, slight sell off in front of the quarter. I think that'll bring down the expectations. Again, like I said, they're 4.4 is kind of the stated number. The buy side whispers around that 6.5. So maybe with the stock selling off a little bit, that number needs to be 6 million. It should be enough.
And I'm always curious, too, about just kind of the relative value of a stock like this. I mean, we talk about Netflix as it's kind of as just this one thing, but if you want that exposure to streaming or really just the entertainment space overall, I mean, how does this stack up against, HBO Max, against Disney and the other players in this space?
Oh, they've won out. They are the king of streaming, right? And Disney's tried, Paramount's tried. No one's solved it. Netflix has the content. They're actually going, the other driver going forward is they're going into live sports. They're actually going to have an NFL game in December, actually 2 games. So that and having a boxing event next month. So again, they've been doing some sports content, but now they're actually getting into live sports. I think that will help their advertising business as well.
CEO Ted Sarandos has said that Netflix is pro-profit. How do you read that? What do you think that means in terms of what kind of initiatives they're going to take on? What other ways they're going to monetize what they do have?
Well, if you go back, look at the peak spending in content was 2021. That number's actually come down last couple of years. It's kind of remained flat. Again, so they're focusing on margins, not just buying all the content, growing subscribers at all costs. They're going to focus more on margins. That's what the shift is to the ad tier as well, right? Ad tier is going to be more profitable for them, a better business model going forward. So that is the focus for them going forward.
We only have about a minute left, Keith. I'm curious, if you were on that call today and you had a chance to ask a question, what's the one question that you would want answered?
I want a little more clarity on exactly how many subscribers are on the ad tier and kind of what their growth the growth rate plan going forward is. That's going to be the key for them, again, because they're not going to report subs in 2025. So that's been a driver for the last several years. Everybody's, hooked on what the net subs are. That number is going away. So we need to hear about margins and where the ad tier is going.
All right, Keith, always appreciate you taking time for us. Keith Gangl, Portfolio Manager over at Gradient Investments. A closer look at Netflix as we await those earnings coming after the bell tonight. Those bells coming up in just about 3 minutes. We should point out Netflix down for a 5th straight day here. A big sell-off into these earnings. A bit of a change from what we saw during past earnings periods.
Yeah, and I really like what Keith just told us about the whisper number and the expected number. I mean, this is only going to be 2 more quarters where we even fixate on these subscriber growth numbers.
Well, I'm going to keep fixating on it. I mean, obviously, Reed Hastings and his cohort aren't. I mean, look, I know they don't want us to focus on that, but people are still going to focus on it because it matters. And I guarantee you, they're not going to give us the numbers, but every call, the analyst is going to ask, what's the negative growth? So they're going to go back to giving the numbers. That's my prediction. Bold call by Romaine as we move closer to the closing bells. Stick with us. A full breakdown of all the market action starts now.
The closing bell. Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick here with Scarlet Food, taking you to the closing bell, a global simulcast. It starts right now. Tim Stenovic joining us in the radio booth. Molly Smith by his side. Carol Masser, for some reason or another, has the day off. But we still welcome our audiences across all of our Bloomberg platforms because we four are here to keep it going.
Are you ready?
No.
You know what I'm asking about?
I have no idea.
Netflix.
Oh, yeah, I've heard.
All right.
Okay.
Here are the
Molly,
numbers.
welcome.
We need to, welcome, Molly. Carol was here earlier.
Yeah.
Guys.
I know. I keep seeing her, but then she doesn't show up for this show.
She was here.
What's happening. Yeah.
Look,
When she doesn't make it onto our show, Romaine considers her not here.
Yeah, pretty much.
Okay.
I think she was here since like 4 a.m, just in Carol's defense.
I see how it works.
We're very close-centric right now.
Very briefly, guys, streaming paid net change estimate for the subscriber numbers for Netflix. We're expecting 4.47 million. Don't get too used to getting these numbers, though, because come next year, we're not going to get those anymore.
You know, there's a whisper number out there, too.
What's the whisper?
6.5 million. Ooh, it's a big gap.
There you go. That's a big gap. And it gets to this idea, too, as to sort of what's going to be really the most important driver. And when we talk about the idea, okay, they want us to focus on profit. They want us to focus on top-line revenue, too. But sort of what's the in-between there that we're going to be able to use to parse where that's going if they're not giving us those subscriber numbers?
Average revenue per member.
They're not giving us that either. They're suspending that after next quarter.
But the revenue per member?
Yeah, we just had Tim Nollen from Macquarie. He said, that's gone, man.
Oh, I thought Geetha told us earlier that's what we have to look for starting next year. I know
Tim, you're living in the past, man.
I know
you got to move to the future here. Let's get through the numbers real quick here before those earnings cross the wire here. You have green across some of the major indices here, though modest gains on the day. A Dow Jones Industrial Average looks like it's going to settle higher by about 0.4%. We're just going to call the S&P 500 and the NASDAQ unchanged, and the Russell 2000 lower here on the day. Netflix earnings crossing the wire. You want streaming ads? You got them. 5.1 million new subscribers added in the most recent quarter on a net basis. The street had been looking for 4.5 million. Revenue for the full year, fiscal 2025, the company is expecting $43 to $44 billion. The street, guys, was looking for 43.4.
Okay, let's take a look at margins as well. Netflix sees full-year operating margin at 27%. Previously, it had seen 26%. The consensus estimate was for 25.9%. And I bring this up because Netflix wants everyone to focus on profitability and margins in particular. It's moving away, as we mentioned, from those subscriber growth numbers. It really wants you to look at margins, and it wants to achieve that through advertising. And the paid advertising here is what we're all paying attention to now.
The company saying that their content has been a little patchy because of the impact of the Hollywood strikes. So still feeling the effects of those, given that, the production timeline for this stuff is relatively extended. And what they have now, they've been working on for quite a while. So Molly's still seeing the effect of those strikes when it comes to the content that's coming out.
Yeah, I mean, I think that, if there was another, a different positive to take from this, just thinking back to when I used to cover credit and we're all about looking at free cash flow, that looked pretty positive. That's up 16% year over year, came in at roughly 2.2 billion. Estimate was for 1.7. So that's a nice beat on the free cash flow. And I'm sure all the bond guys out there are definitely liking that. I mean, Netflix, not the biggest borrower out there, but I mean, still a pretty solid name if you're looking to trade that one.
Looking through the shareholder letter, they do talk a little bit about that ad membership, saying ad memberships up 35% quarter on quarter, and the ad tech platform, something that Tim Nollen at Macquarie was talking about a little bit earlier on the program, that is on track to actually launch in Canada in Q4. So now expanding to new markets. And we were just talking with Keith Gangl over at Gradient, really talking about the potential impact that live events could have. And this gets to your comment, Tim, this idea about content here. Of course, that big Jake Paul-Mike Tyson fight that nobody asked for, but we're still going to get. And of course, those 2 NFL games on Christmas Day.
Yeah, forget playing with all the toys you get from Santa Claus. There are 2 NFL games happening on Christmas Day on Netflix. Other stuff that they talk about being breakout hit shows, not going to surprise you if you've been paying at all any attention to the zeitgeist. Monsters, the Lyle and Eric Menendez story from Ryan Murphy, The Perfect Couple with Nicole Kidman.
Yeah.
Nobody wants this.
Now,
did you say nobody wants this?
Wait, what happened with Monsters? Now, did they not do it? I'm confused because every time I see some of these Netflix specials on these like murder investigations, it's always like, apparently we all got it wrong.
Yeah. Well, I don't know.
Yeah.
I haven't
Scarlett,
seen
you
them.
watch a lot of TV.
I haven't
tell me.
finished it yet, so I can't tell you much.
There's two of them, though. There's two of them.
I hear they're brothers, right?
No, not just
competing stories. Yeah.
Monsters, the Lyle and Eric Menendez story, and then there's the Menendez brothers documentary also. Yeah.
I have watched Nobody Wants This. It's great. I also watched A Perfect Couple. So yeah, Romaine's right. I do watch a lot of Netflix. One thing I want to point out,
Perfect Couple, was that the Liam, what's the guy's name? Liev Schreiber?
Liev Schreiber and Nicole
I actually
Kidman.
saw that. See, I
Yeah.
saw something, Scarlett. I'm
You know,
proud of
there was
myself.
some embedded
Look at me.
advertising in that because they were talking about Doritos
Yeah.
and Cool Ranch chips, and
Yeah.
I feel like that is something that Netflix
Yeah.
is going to lean more towards in the future.
But don't tell me the end, because I actually didn't see the end. So I have no idea.
can't
I have no
believe you
idea who
didn't
killed
finish
who, but there you go.
I mean, as far as what we're looking forward to in the fourth quarter, I mean, Netflix is highlighting here, we're going to have the returning hit. Squid Game Season 2 is coming back. I personally, I don't know if you guys were into that one the first time around. I mean, that was a massive show when that first debuted. Outer Banks Season 4, Love is Blind Season 7. Tim and I were just talking about that one where the cast is set in D.C. and none of these people seem to have D.C.-related jobs. But I think that Love is Blind, and obviously in the other markets they've explored too,
is it
with
like
the
Congress
UK.
people hooking up or what?
It's crazy. I literally just finished Season 6, so I'm genuinely a year behind, but I'm very eager to start watching it.
I'm 6 years behind, so
Yeah,
don't
so
feel bad, Molly. But getting back to the numbers, though, too, it does get, in all seriousness, it gets to this idea of what you want to hear from Reed Hastings on that call, which is kind of a scripted call, but still, what's the vision that he's going to articulate? Because we talk about this idea of not having visibility through those traditional metrics.
Look,
is he going to offer up something else, Tim?
Look, if you're an investor and you're a customer, you want two different things. If you're an investor, you want to hear about a price raise in the United States.
Yes.
If you're a customer, you don't want to hear about that.
No.
You also want to hear, if you're an investor, about what they're doing in terms of advertising and what that advertising product looks like since launching it just a couple of years ago. They do say in the letter, we have more work to do improving our offering for advertisers. It'll be a priority over the next few years. They're going to do an in-house first-party ad tech platform. Yeah. They're going to roll it out in Canada, broader ads to countries in 2025. Remember who they're competing with here when it comes to advertising. I mean, you're competing with the huge players, the Googles of the world, the Meta platforms of the world, the TikToks of the world, Instagram, everybody out there.
I just want to point out, too, just the share reaction here, too. This is probably one of the more tepid share reactions we've seen in Netflix. Now, coming into today, the market was basically saying we were going to get about an 8% up or down move, of course, in the cash session tomorrow. But to see the post-market move of just a fraction of a percent is kind of alarming. Yeah, and to Tim's point, I think the stock will really move in after-hours trade once they do get any kind of clarity on what the paid subscribers and the advertising revenue looks like for that tier. One thing worth noting here is that revenue is slated to slow down sequentially the next couple of quarters. For the third quarter, revenue rose about 15%. For the fourth quarter, it's seen staying at around that level. And then first quarter of next year, revenue is seen slowing to 13%. Second quarter seen slowing down to 12%. But the thing about that is, so I went back and looked through those numbers, like really go back over the last few years. They've been in this position before, where you've seen that slowdown in that revenue growth number, and somehow they've always found a way to get that back up, whether it's with new content or whatever.
Or price increases.
Or price increases, but that's, they have pricing power.
But they do have pricing power, and I think that's going to be, at least in the U.S. and Canada, the lever that they're going to have to pull, because, given that the penetration has increased here with the crackdown on password sharing, that's kind of short-lived, according to analysts. The only way for them to actually grow when it comes to revenue is to raise their prices. But
just real quickly, though, why not the international markets? Because when you look through this release here and you look at the performance in international markets, it's negative signs in front of everything in terms of growth. I mean, I thought that was supposed to be the big expansion plan a couple of years ago.
It was when they flipped that switch at CES like 10 years ago, and they said, Netflix is now available worldwide. That was the huge opportunity. Every market is different. We'll have to wait and see what they say on the call about where they see the most prospect for growth.
Yeah, and I mean, also just a lot of questions right now swirling about how, the valuation of the stock and how expensive it is. I mean, again, we're talking about a pretty muted market reaction right now, but if that materially changes after this, I mean, this is a stock that's up almost 340% from 2 years ago. So pretty crazy rise.
Absolutely. People are looking for reasons to buy the stock, and they need more clarity. They need more clarity on the number of subscribers added to the advertising tier.
Romaine, what are you watching on Netflix right now?
Zero, nothing. Squadouche.
He's going to watch the end of The Perfect Couple.
Yeah, I don't know. Probably
we just started Slow Horses
a year and a half.
On
That's Apple.
Heard it's great.
Yeah.
So far, so
Never
good.
heard of that either.
I think that's the challenge, though. Carol mentioned a thing that she was watching on Netflix on our program. Turns out it wasn't even on Netflix because, customers don't necessarily know where they're going. Hey, we got to go.
Do you hear the same thing in my ear? That
Yeah, our producer's saying
when the
rapid,
producer
rapid,
says
rapid.
we got to go, or just checking.
All right. Okay, I'm going to let that one go. That's for Finley in our ears. That is going to do it for our cross-platform coverage.
I thought that was just
on radio, TV, YouTube, and at Bloomberg Originals. We'll see you tomorrow, same time, same place.
Staying on top of Netflix results, the share is now starting to see a little bit more activity here in the after-hour trade. 5 million customers added in the most recent quarter, eclipsing Wall Street estimates. Sales in the period up 15% to $9.83 billion. Geetha Ranganathan joining us right now, who covers this space for us over at Bloomberg Intelligence here. Top and bottom line, they look pretty good to me, Geetha. How'd you see it?
They look very, very good, Romaine. And I think the one big thing that, we were looking for was guidance in terms of operating margin. So obviously they raised their guidance for 2024 from 26% operating margin. That was already a 500 basis point increase from the previous year. They raised it now to 27%. But I think what was a little bit disappointing is we're only going to see, they're targeting only about 28% in 2025. So obviously it looks like we've kind of pulled forward some of that operating margin expansion. So that I think is going to be a key focal point going forward. I mean, I'm not sure if they're just being conservative or how to map this out. But I think one thing that, investors were really looking for and didn't get was the announcement on price increases, because now there's less clarity, as you pointed out, into the revenue growth trajectory.
Does that mean it's not going to happen anytime soon, or is this something that in the past they've announced during the earnings call and didn't include in the actual letter to shareholders?
I'm not sure whether they're going to announce it on the earnings call. They're probably working through some more of the different things. I mean, we kind of have to look at the whole change in the narrative now for Netflix. They are going to stop reporting subscribers. So this is going to go from, a subscriber story to a top line story. And as you, pointed out in the segment before, advertising is obviously going to be a big part of that. And how big the advertising portion gets is definitely dependent on how much they are going to raise prices. If they're going to price people out, if they're going to raise the standard plan price from, let's say, $15.50 to $20, that means they're going to drive more people to that ad-based tier. So it's going to be interesting to see how they want to play this. You also pointed out that they have huge pieces of programming coming on in the fourth quarter, all of which play really well to that advertising base. So again, it's probably just a timing issue.
That's a good point. I do want to get your thoughts here on the cost side of the business. When we talk about revenue, the cost of those revenues, at least about 50%, more than 50% of the actual top line number. I know that's been pretty consistent for this company, but when you talk about the amount of content that they have to produce and the amount that they have to pay, Geetha, are you comfortable with that spend?
I definitely have seen a huge, and this has been across the board, Romaine. There has been this huge content cost rationalization, and definitely it's the same for Netflix. We're seeing them take a much more balanced approach towards kind of green-lighting new shows. We're also seeing them kind of really expand their catalog, going into different genres, some of which has happened to be much more cost-effective, apart from, of course, the local language programming. But again, we are going to have to see what happens in 2025. As they try to build out this advertising business, do they have to go after more expensive sports content? And that, of course, then can, skew that equation a little bit.
Geetha, everyone's so fixated on the number of subscribers added to the advertising tier in the U.S. and Canada, but they're not providing us those details. Why do you think that's the case? They just want it to stabilize more. They're still building out the strategy. I mean, at some point, especially as they start to not tell us their actual subscriber numbers, they're going to have to give more details.
They are going to have to give more details, but I really think they're looking to build a critical mass here, Scarlett. So they did give us some, scattered data points. We know they have well over 40 million monthly active users. Now, the typical math there is, it's 2 viewers or 2 monthly active users equals 1 subscription. So, people have guesstimated they probably have anywhere from about 19 to 20 million, ad-based subscribers. Again, I think they're playing this very, very carefully. Remember, there are a lot of things that are happening here. They're beefing up their programming to make it more attractive to advertisers. They're also kind of re-engineering their whole ad tech strategy. So they're building their own in-house ad tech, and they're also opening up to third-party partnerships, whether it's with the Trade Desk, whether it's with Google. So that makes more of their inventory available in the marketplace. And they're doing that in conjunction with kind of really ramping up ad revenue. So I think they're looking to build a critical mass before they actually start reporting numbers.
All right, good stuff. Geetha, really appreciate your giving us the instant analysis. You can see Netflix shares now up 5% in after-hours trading. Geetha Ranganathan of Bloomberg Intelligence. Let's now move to an investor who owns shares in Netflix and bring in Matt Stucky, Chief Portfolio Manager of Equities at Northwestern Mutual Wealth Management. He joins us now. Matt, your initial reaction to this latest set of results?
Well, thanks for having me, Scarlett. I think this is right down the fairway for a lot of what investors wanted to see. They wanted to see continued margin expansion. They wanted to see continued healthy sub growth. And most importantly, the forecast on how 2025 is shaping up in their minds. And if you look at the numbers, they're guiding to another 14.5% revenue growth for the entirety of 2025 and continued margin expansion, which, there's upside there if ads continue to scale and the ad tech works well with the candidate test. And so in terms of, an investor's perspective, here, it was a solid quarter.
Okay, solid quarter. When it comes to building out this advertising tier, is the default going to be they want to push all new subscribers to this advertising tier because it's so much more profitable than the standard non-ad tier?
Well, I think they want to probably underprice for a while to build a critical mass and attract live events to Netflix's platform to really kind of monetize that way versus really kind of pulling the pricing lever initially. In markets where it's available, they've taken out the basic tier to channel sub growth in the ad tier space. But I think that they understand their customer base really well, that certain customers are going to navigate towards that. But over time, I do see broadcast opportunities as being a hybrid between both ad supported and premium members as a way to kind of grow the advertising base. So it's not necessarily just stuffing in subscribers into the lowest ad-supported tier, but enjoying the benefits across the spectrum of subscribers.
On content, Matt, we're talking about a big spend right now in some of those live sports arenas or live event arenas, I should say. And there's been a lot of discussion about how that's great for the ad side of the business. One aspect of that I'm curious about is the idea of repeat viewing. We know with a lot of the content that they have on the platform, it's kind of, just brain dead viewing. You turn on Seinfeld or some other old program and you could just churn that over and over again. I don't know how many people are going to come back and, watch the Aaron Rodgers, lose again, 3 weeks after it already happened. Maybe one of our producers will, but I certainly won't. Is there a sort of a longer term financial benefit to some of those live events beyond just the day they air?
I think that there is, just in terms of keeping Netflix a critical part of everybody's subscriber pack these days. I think the content spend is likely to lift higher versus what we've seen as a result of them investing in live events. Just the secret sauce of Netflix the last 5 years is growing revenues, 14-15% per year, and only growing content spend by 3% per year. That's pushed margins on the operating side from 12% up to 27% for the full year in 2024 here. So, for them to continue that, I think it's probably going to slow down that pace of margin expansion because they're going to have to invest more to bring more eyeballs on the broadcast side through their partnerships with, again, the NFL coming up on Christmas Day. And so expansion beyond that, I think, just keeps the whole ecosystem healthy and fresh from a content perspective.
I am curious just in general about management. Reed Hastings, of course, has been at the helm of this company since its inception. Ted Sarandos has been there for a great deal of time as well here. Are you comfortable right now with the management that's in place, the executive management that's in place, and more importantly, whether there's any sort of succession planning afoot?
Well, we're big fans of Reed in terms of the job he's done. We hope he stays at the helm for a long period of time. But I think the culture of Netflix is, permeates throughout the organization. And so whoever takes over is likely to be handed a very healthy business with a firm understanding of what their subscribers want and need and how to grow the company in the future.
I think about the things that Netflix has said it wouldn't do in the past, and it's gone back on its word several times, right? It used to say you could share your password. That's how you show love. It's, of course, then cracked down on password sharing. It said that it would never have advertising, and, of course, it's added this ad tier. It said that it wouldn't go into sports, and now it's going to be showing 2 NFL games over Christmas. This might bug subscribers or maybe, delight them if you're an NFL fan, but is this problematic for shareholders that you don't always trust what Netflix is telling you, at least at the moment?
Well, I think that they're reactive to the environment that they're working in. I think customers sometimes may think that they want, just an ad-supported tier, but they really just want, in other cases, another subscriber just wants, something that's more premium without ads. And so, creating the full menu of options depending on the diversity of their subscriber base makes a lot of sense to me. I think we kind of go back to the original decision that Netflix said they wouldn't do, which was investing in original content. Of course, that was a great thing for them to do. And now, their content spend is half between originals and half between, third-party licensed content. And so, they're always learning, they're always iterating. And I think that's a healthy thing, not a bad thing for, if you're looking to evaluate the effectiveness of Netflix executive team over the years.
Do you have any sort of anticipation that Netflix could broaden effectively what it does? This idea here that it is a very narrow focus right now, and that's benefited it in a way that some of its competitors haven't had the luxury of. But there's been a lot of talk as to whether they would move into something like a more of a Disney type of operation with theme parks and merchandising, et cetera.
Well, I think the merchandising is the next natural extension. But, if you look around, the collective TAM of CTV around the world, it's around 500 million or so households, and their subscriber base now is just clocked in above 280 million at 283 million after today's report. And so there's still room to grow there, especially internationally, where streaming is only 20% of TV watched in terms of the minutes that are viewed by audiences globally. Thinking through what's next for Netflix, I think potentially a lot of it is going to be predicated on how this live broadcast works out for them. They're a test and learn organization, and if this goes well, who's not to say that they expand further into that and become more of like a YouTube TV kind of quasi premium type of format down the road? And what does that do for the business? I think that's all kind of an interesting kind of long-term Netflix discussion that we could have.
Absolutely. Interesting too. Now, of course, they are being a little bit more forthcoming with viewership and engagement numbers here, which gives us a little bit more insight here into what works and what doesn't. Matt, appreciate you taking time being with us. Matt Stucky is the Chief Portfolio Manager of Equities over at Northwestern Mutual Wealth Management. As Netflix shares continue to drift higher here in the after-hours trade as we wait for that telecast by the company to take place. When we come back, we're going to get to do a deeper dive into the streaming space writ large with Ross Spanish, TV and streaming senior analyst at Emarketer. That's coming up next. This is The Close on Bloomberg. We are focused on Netflix. Those earnings just out, a beat on both the top and the bottom line, a beat on those streaming numbers, which of course they want to move everyone away from. The share is moving higher now, up about 4%. And there's a lot of discussion right now about competition within the streaming space, how that's ramping up as streamflation takes shape. Disney Plus already raising the price of its ad-free plan to $16. That's higher than Netflix's standard plan of $15.49. But that could change, or at least that is the expectation of investors. Ross Spanish joining us right now. He's the TV and streaming senior analyst at Emarketer, which provides forecasts and insights across marketing, advertising, and commerce landscapes. Let's start with this whole idea. We know that to a certain extent, Netflix has this pricing power, and if its competitors are going to boost their prices, why wouldn't Netflix? So maybe we didn't get that today, at least certainly not in the press release. But do you anticipate we're going to get that sometime soon?
I'd expect another price increase within a year. They've really become hyper-focused on revenue. And when you've become tapped out in how many subscribers you can add, especially in the US, price increase is the natural place to go to boost those revenues.
It gets to this idea, though, of how sticky Netflix is. One thing that jumped out in the letter to shareholders, they talked about the amount of engagement that they have. They've released a lot more engagement numbers, what people are watching, and more importantly, how long they're watching, how much time they're spending with Netflix. Is that going to be an advantage to them?
It is an advantage, and they shared today that across the accounts, on average, people are spending about 2 hours per day on an account, and they're sharing that number because it makes them look good. Other than YouTube, there's no other streaming service that compares at all to Netflix in terms of time spent, and most of YouTube's viewers are free. So they're not sharing the ad revenues because those are quite low. They'll share the time spent figures because they're blowing everyone else out of the water in their area.
Even though they've got a time share of 2 hours per day, we don't know the level of engagement that is. Because I think about how my husband watches Netflix. He watches the first 20 minutes of a show, and then Monsters will continue to air, and he's already asleep. So you're not getting a clean read there on just how committed viewers are.
I totally agree with that. I've fallen asleep with my daughter watching Gabby's Dollhouse, and neither of us really have our eyeballs on the screen, but it might play for 3 hours or so. So that definitely happens, but that's always been with us. I mean, when you think about ratings for Johnny Carson's show on late night TV back in the day, how many of those viewers were even awake? You know what I mean?
Mm-hmm.
Yeah.
Yeah, that's a good point. So, I mean, obviously everyone will want to ask about ad revenue, and they'll likely press the executives on it, and we probably won't get very much by way of detail. But what do you think they're waiting for before they do say something about it? Is it to reach a critical mass? And if so, what is that critical mass?
Well, they'd want to cross at least $1 billion annually in the U.S. And they're right at that point now, but they haven't hit it. For users, I suspect they would wait till they have at least a fourth of their viewers on the ad tier right now. Right now, we forecast that the ad tier is only about a tenth of their viewers, and it is growing. But you'd probably want at least a fourth before you share some sort of like big viewership number, because by contrast, Hulu has about 2/3 of their viewers on the ad plan, and Peacock has about 3/4.
I am curious, though, about the broader streaming space right now, Ross. There's been a lot of talk about maybe the potential for consolidation and a lot of discussion about the word that I thought was somewhere behind us, which is bundle. We're kind of going back to the old days here. But some of the other streaming services, the ones not named Netflix, seem to be finding some degree in value of maybe experimenting with some type of bundling with the other services. Do you ever think Netflix would consider something like that?
Netflix will only do bundling right now if it's for their ad plan, because they're trying to grow the ad-supported viewers. So if they're going to let a telecom do a promo through a bundle or work with another streaming service, they're only going to offer the ad plan. They won't go into a broader, more option-based bundling like you've seen with Max and the Disney services, because Netflix is already used by all those services customers. They don't have the incentive to bundle. And most of Netflix's viewers have been there for a long time and haven't canceled, so they don't have the churn problem that some of these other streaming services have. So they just overall have less incentive to do that.
What about a one-off bundle or, just a special promotion for those 2 NFL games that they're going to play on Christmas Day?
I mean, that makes sense if they did an ad tier bundle, like only offering the ad tier with another streaming service that is sports heavy, maybe let's say like Peacock or something like that. That makes sense for a limited time, but I don't think they're going to put the ad-free product in that.
Okay, good stuff. Ross Bennis, TV and streaming senior analyst at Emarketer, which provides forecasts and insights across marketing, advertising, and commerce landscapes. Ramin?
All right, we got a lot more coming up here. Of course, we are going to stick and talk a lot more about Netflix, talk a lot more about what's going on in the entertainment space. And we're going to take a look back at this day in history. It was actually this day, Scarlett, as a little nerdy guy over in the UK created the Internet Movie Database. You might have heard of that.
Yeah, I love this app.
There's a lot more to the story. He unintentionally gave birth to Amazon's video streaming ambitions. You definitely want to hear this story. We'll be back in a moment.
I'm into it.
This is The Close on Bloomberg. All right, let's take a look back at this day in history. 34 years ago, when a film buff in the UK named Colin Needham launched the rec.arts.movies movie database, which fortunately for all of us was later streamlined to the Internet Movie Database, or IMDb. Now, Needham had been keeping a paper diary of all the films that he watched and the people who starred in them. And then he decided, well, why not just transfer those to a computer file? He pulled data from other like-minded collectors, and on October 17th, 1990, published the first version of the IMDb software. The site, which predates modern web browsers, by the way, took off, becoming so popular that by 1996, Needham quit his day job as a computer engineer at HP. And a year later, though, that's when all things changed. In December 1997, Amazon's general counsel reached out to Needham and asked for a meeting that Needham assumed would be about Amazon advertising on his website. Instead, he found himself sitting across the table from Jeff Bezos himself, who made a pitch to buy Needham's company. At the time, Amazon was pulling in a measly $600 million a year in annual sales, almost entirely from books. But as a newly public company, it needed growth, and that would come quicker through product diversification. Bezos put an offer on the table, $55 million, which Needham accepted, and IMDb, along with the internet company's book pages and Telebook, became on that day, the same day, the first acquisitions Amazon ever made. The press release back then is really worth reading because there was one key nugget in there that said the IMDb deal would, quote, support its eventual entry into online video. And indeed, it did. First laying the foundation for Amazon to sell DVDs, then for IMDb to become a platform to help Hollywood agents and filmmakers whiteboard their ideas. And then in 2006, as a hub for Amazon's on-demand video service, Prime, which all eventually opened the door for Bezos to launch his own Hollywood studio in 2010. That turned Earth's biggest bookstore into one of Earth's biggest entertainment companies. A video streaming platform that today boasts the second highest number of original hits, according to Nielsen and Parrot Analytics. And while Netflix is still, by far, the 800-pound streaming gorilla, commanding almost 40% of the market for original streaming content, Amazon is second and rising fast. As for Needham, he's still the general manager of IMDb, making him among the longest-tenured Amazon employees. And his IMDb ratings list is still active, showing that he's watched almost 16,000 unique films over the years. Among his 10 favorites, Pulp Fiction, Aliens, Vertigo, Inception, and probably my favorite, Scarlett, Double Indemnity.
That is a great origin story. I love it. And by the way, IMDb is kind of like a LinkedIn for the Hollywood set, for actors and producers. You could see a selection of their resume as well on there. All right, let's stay with streaming. And as we know, one of the main competitors of Amazon Prime is Netflix, the streaming giant diving into the world of live entertainment. It has recently ordered a live variety talk show with the comedian John Mulaney. Joining us now to discuss all of this is Bloomberg's Chris Palmeri, who covers media and entertainment for us in Los Angeles. So, Chris, when Netflix has or orders up a live talk show with John Mulaney, it feels kind of contradictory because Netflix's content is meant to live there forever, but live talk shows always focus on the here and now, what's urgent, what's current, politics, whatever is showing on Netflix or your streaming service.
Well, of course, Netflix, pioneered the library of content, the movies, like you said, that you just want to go and watch when you want to watch them, and TV shows, it's not a certain time you have to tune in. But they're really, as they've gotten so big, they're moving into almost every area of entertainment content. And live has really been a big focus in the last few months. As we were the first to report, they have this John Mulaney variety show. They were also next year starting up the WWE, the live wrestling program. Come Christmas Day, they're going to have 2 NFL football games. So this is the direction they're moving. Now, they've said they don't want to go full on these really expensive sports rights. Yeah. But we're seeing, and other streamers as well, moving more into the live space.
Well, that's what I'm curious about. I mean, these are pretty expensive endeavors, and maybe it pays off. I am curious, though, how it sort of ranks. Is there, say, maybe a potentially more bang for the buck of doing kind of John Mulaney type of events, meaning live stand-up or live variety shows, as opposed to the big sports, Christmas Day games that are going to cost, no matter what they do, an arm and a leg?
Well, to Netflix's credit, they're very, very canny, and like if you look at something like the Tom Brady roast, that was huge for them, just a one-off, but it was live, and so they've not gotten head-to-head on these big sports rights, but they found unique ways to also attract those moments that everyone congregates to watch something.
Do we have any sense of how expensive these live shows will be? I mean, obviously the NFL games are, in a world of their own, but I'm talking about these talk shows or these variety shows.
Not as expensive as some of your premier dramas, which can be $10, $20 million an episode. The Brady one was expensive because, involved licensing one of the most famous people on earth, but they, tend to be, and comedy's been a real big focus, a lot cheaper than some of the more scripted dramas that everyone buys.
I'm curious, Chris, are we going to see more of this, not just with Netflix, but I mean with all the streamers and the big entertainment companies out there? I mean, is there real value in continuing to go down this road?
Certainly seems that way. You're seeing now live election coverage on election night. You're seeing all kinds of new avenues where these people are exploring this. Now, it may turn out to not work in the streaming format, but given everybody now having some level of live sports and I think this is the direction of moving. We're just, the streaming business is becoming a lot like the traditional TV business.
Yeah, it's kind of a merging of the two, a blurring of the lines.
That's a good or bad thing.
Right, exactly. All right, Chris Palmeri joining us from Los Angeles. Thank you so much. Of course, we've been knee-deep in Netflix's results, but if you take a look at what happened on the day in the cash market, not a whole lot going on in the S&P 500. There was some action remain in the chip space because of TSMC's latest results. It was a beat-and-raise quarter, and there was a lot of activity in treasuries.
And I don't know what to make of the whole ASML thing now. Because it was like, that was like, oh my God, gloom and doom. And then TSMC comes out and says, you know what, we're fine. So I don't know. I guess maybe we just have to wait for the real, granddaddy of them all and what NVIDIA says. And
at the very end of earnings season.
A month and a half time or whenever it is.
Yeah, that may very well be.
We had a rate decision today.
We did. The ECB cut rates for a second straight meeting. Christine Lagarde said the decision was unanimous.
Oh.
Unlike the U.S.
Oh, okay. There's a lot of things unlike the U.S. going on here right now. All right, keep an eye here on some of the after-hours move. Of course, Netflix, one of the bigger movers, at least among the big cap stocks. You see the big boost there, now up about 4%. The conference call, a telecall, whatever you want to call it, hasn't started yet. Not seeing much of a reaction in some of its peers there. Amazon and Disney only up fractionally right now.
Yeah, and Apple and his Apple Plus is, it's a player, but it's not anywhere.
Apple Plus?
I do.
I don't know anyone who has Apple Plus other than like the 3 free months you get when you buy it.
I know. I got into slow horses, so that's why.
I don't know what that is, but Charlotte will explain it to me during the break. This is The Close on Bloomberg.
Gary.
All right, welcome back. We have been focusing today on Netflix and really the broader entertainment industry. We were just talking about some of the live events that Netflix itself has planned, whether it be stand-up comedy or Love is Blind reunion. Streaming live sports and other events is the next order of business for Netflix. Here to talk a little bit more about that is David Joyce, senior analyst at Seaport Research Partners, because it currently has a neutral rating on the shares. And really, we want to kind of broaden this conversation out to a lot of the venues as well that, of course, also potentially benefited from it, whether the MSG or the Sphere or Live Nation, if you will. And I'd be remiss, David, I think my producer would be upset with me. I didn't point out that Taylor Swift apparently is going back on tour, starting the final leg of her tour later tonight in Miami. Let's talk about the health right now of the live entertainment business, whether it is music concerts or sporting events. This just seems to be the juggernaut that doesn't stop to a certain extent. Do you see that continuing?
I do see it still continuing. I think it is an outcropping of a development about a decade old where millennials started to spend money on experiences rather than things. And it really accelerated after we came out of COVID because people were cooped up in their location for so long. They wanted to get out and about. So you really have a healthy consumer who is really applying their discretionary income to going to all of these events, sporting events, music events, comedy, and there's a lot more supply to meet that demand. Even IMAX screens. People have to go to see IMAX because that's more of an experience than a regular theater. But Netflix is tapping into that as well because they've got the intellectual property that people want to engage with. Be it Bridgerton experiences or Squid Games. So it's really healthy consumer.
Well, that's what I'm curious about as to how the live events transfers over onto the screen, the Netflix screen, if you will, or vice versa, taking what's on the Netflix screen, as you allude to with Bridgerton, and hopefully creating a better Bridgerton experience in real life.
It is all about engagement. So once people do latch on to some piece of content, some piece of property, there are going to be multiple ways that a company can monetize that. And Netflix is taking it beyond the screen. But again, they started it with the screen. And people who are the uber fans of any given piece of content that really gets to that level of excitement, it turns into something where they can keep monetizing it and extending the life of that. And it does translate into continued success at Netflix because it helps to retain subscribers. If they then have the ability to create another season of it, that extends the lifetime value that of that consumer and the piece of content.
Yeah, it feels like the Disneyfication of some Netflix content. So that being the case, do you see Netflix also moving into, say, amusement parks or partnering with an amusement park to get some of their programming, some of those franchises into those parks?
I would see them partnering or licensing their content. I wouldn't see that becoming a capital-heavy business for them. That's not their core competence. But you definitely could have some of those experiences, and there would be an array of potential partners there.
Yeah, I mean, the experiences is a tricky part because there's a lot of other people out there who are trying to tap into that popularity, and they may not have the official Bridgerton party, but they're throwing their own versions of Bridgerton party, sometimes not great versions either. When we talk about some of the other companies that you cover, like Live Nation or Madison Square Garden or Sphere Entertainment, how do venues increase their monetization of the live events that they do host, aside from continuously raising the ticket prices, adding tiered pricing or premium add-ons or premium events within that big event?
Right. One of the core ways that these companies are still developing growth is going into the marketing world and developing more sponsorship partnerships. Sponsors have been reallocating their marketing spend away from legacy media, linear TV, print, sort of thing, and going where the consumer is. They want those live interactions. So there are more and more creative ways to come up with these consumer interactions at festivals, or having new types of display, like WWE rings didn't have branding before. TKO's UFC has been doing a lot on sponsorship. Now you've got the Sphere and the other MSG-related partner companies partnering with the Tourism Bureau of Abu Dhabi when they're opening another Sphere over there. But they're also now a patch partner for the Knicks. So there's a lot of creative ways that the sponsors can help drive new revenue streams for all of these live entertainment companies.
All right, David, really appreciate you joining us. David Joyce over at Seaport Research. A closer look here at all of those live events. I don't know, you're a live event. I know I've seen you go to some concerts.
I go to concerts, I go to sporting events.
Yeah, did you go to that Bridgerton event that was like, a
the sad one?
Yes,
no.
Bridgerton.
I did enjoy
because
looking at
Netflix
social
can
media.
lean into that and actually create some real officially sanctioned Bridgerton events. That might actually be kind of cool.
No, they have. It's just that other people are also jumping on the bandwagon, and that becomes a problem.
Absolutely. All right, we got a lot to talk about. And too, I mean, one thing we didn't touch on too, we talk about all these shows and stuff here. You need a lot of data centers to run that stuff.
Oh, absolutely.
Right,
a lot of power.
How's that for a segue, Scarlett?
Nice work.
We're going to talk a little bit more about data centers when we come back after the break, particularly in light of that AI boom, and set you up also for some of the market moving events over the next 24 hours. A lot more coming up here on The Close. This is Bloomberg.
The AI boom sparking a $2 billion bet on DataBank. The data center developer will use the funds to build out 3 large U.S. facilities with the backing of Australia's largest pension fund, as well as DigitalBridge, which is the control investor of DataBank. So here now to talk about this more are the 2 people who are directly involved, longtime partners, Raul Martynek, he is DataBank's CEO, and Marc Ganzi, who is CEO of DigitalBridge. Welcome, gentlemen.
Thank you, Scarlett.
Raul, let me just start with you. You're raising all this money, and you'll be, of course, increasing and building out your footprint. Talk a little bit about the scale that you'll achieve with this latest fundraising.
Sure. So DataBank, we're one of the largest developers in the U.S. of data centers. We have over 70 assets in 26 U.S. markets and over 2,500 customers, about 350 megawatts of installed data center capacity. This new facilities will allow us to build out over 1 gigawatt of data centers across the U.S.
And we've been talking about Netflix all hour because they reported earnings. Netflix is, of course, one of your customers. Their servers sit in your data centers. Are people just knocking down your doors to get more access?
Yeah, it's been, look, the data center sector has been a great sector for a long time. If you think about it, everything that's digital originates and terminates in a data center. So the demand's been there for, well over a decade. Obviously, in the last 24 months with the advent of generative AI, demand has really taken off. So all kinds of companies are looking to harness that technology, and that technology needs data centers, needs NVIDIA chips as the foundation for it.
So, Marc, I assume raising money for a venture like this in this environment is probably way easier than maybe what it was, 10 or 20 years ago. Talk about that.
Well, look, I think LP interest in the sector is at an all-time high. Investors are looking for the next great opportunity in AI. We tell investors very simply, the place to start is the picks and the shovels. And what Raul's doing and what DataBank is doing is supplying that mission critical infrastructure. And so infrastructure investors, pension systems, sovereign wealth funds, they want exposure to the early innings of AI. Best way to play it, be in the infrastructure. Long-term leases, great customers, like you said, like Netflix, Amazon, Microsoft. And most importantly, they really like to back winners. They like to back great management teams. Raul and I have been partners for over 2 decades. We've built multiple companies together. And when you have a great management team and a great secular trend, capital seems to materialize pretty quickly. And in this instance, we were really fortunate to have had the support and partnership of Australia Super.
And Australia Super, and it's funny, I was actually talking with one of the lead managers over there just last week at the Greenwich Forum, and there is a lot of concern right now about the power use that AI requires and how data centers are being built to sort of either be more power efficient or to harness their own power. We've seen deals with Microsoft effectively saying, like, we're going to restart a 3 Mile Island nuclear reactor, something I didn't think I would ever hear in my lifetime, but here we are. So as you sort of take this money and build these things out, how much does energy efficiency have to be a big component in that process?
Well, look, as the sponsor, what we're trying to do is create the best solutions that require the least amount of interference from the grid.
Okay.
I don't think our country really has a power problem per se. We're generating a lot of power. The question is, how do we get the power there? How do we get there that's an efficient way? And then most importantly, how do we solve the problem for our customers, helping achieve their carbon neutral goals? I think one of the things we love about the DataBank investment is Raul started down that journey 7 years ago in terms of moving towards renewable power. And that's a process the company's on, and probably Raul could tell that story better than I could. But
yeah, we're already at over 60% of the kind of the energy that we use comes from renewable sources or via offset with RECs. If you think about the data center sector and the main players, Amazon, Google, the hyperscalers, they're the largest consumers of renewable energy in the world. So you could argue that the data center sector really kind of creates the demand for all this renewable generation. And these latest kind of moves around the nuclear side is just another example of this industry really driving renewable energy solutions into the marketplace.
To what extent was that a conscious decision to seek out alternative sources of fuel, or was this more because it was available and it made more pragmatic sense?
Well, there was 2 reasons. I mean, renewable is, from a price perspective, it's gotten parity with kind of fossil fuels. And, our largest customers, it's an important thing for them, right? Having a roadmap to carbon neutral by 2030 or 2035 is a key corporate initiative of these companies, right? So we want to be aligned with our customers, and we think it's also good business.
I'm going to ask you kind of a weird question, Marc, because when we talk about DigitalBridge and kind of when it started, I mean, it's been around for a while now. You're now riding a wave that I don't think you could have predicted where we are now, or maybe you did. Maybe I don't want to shortchange you here. But when you talk about how quickly technology changes and moves to whatever that next new thing is, and right now it is AI here, how do you make sure that your investments that you're making now are going to be relevant, say, 25 years from now?
Well, look, at the core, we're one part real estate investor, we're one part infrastructure investor. And that really makes us an investor in the real assets category. I think what underpins all of our investments, whether it's one of Raul's data centers, whether it's a long-haul fiber out with Zayo, whether it's a tower vertical bridge with the Verizon deal that we were here a couple weeks ago on, here's the key to our business: long-term customer relationships. We've been doing this 30 years. And so when we have a commitment from a Netflix or an Amazon, and that's a 10-year or 15-year commitment, the best way to stay agnostic in technology as an investor today is have long-term durated cash flows on the other side of your counterparty credit risk. And so what we love about what Raul's doing, we love about all of our businesses, all 46 of our companies around the world today, is we have great long-term relationships with customers. And the great thing is investors, when they invest with us, Romain, they don't have to make a bet on technology. We're providing that neutral, mission-critical infrastructure, which is why people like digital infrastructure today, and why you see the interest level so high. So at the end of the day, yes, technology is important. We have to understand it. It's in our facilities. We have to get close to our customers and make sure that we're evolving with them and building new infrastructure like Raul's doing.
And so that's the key for us, is having great, solid, long-term customer relationships.
All right, Marc, I think we have to leave it there. But this is actually a fascinating topic, and I have a feeling we're going to be talking a lot about this in the months and years to come. A big thanks there to Marc Ganzi, DigitalBridge CEO, and Raul Martynek, DataBank CEO, and of course the latest round of investments. As we close out the program here, some potential market-moving events over the next 24 hours, Scarlett, including that data out of China.
Yeah, third quarter GDP slated to come in at 4.5%. So we'll be looking for that certainly as China stimulus continues.
Earnings in the morning from Amex and Procter & Gamble. Who you got?
You know, Amex is going to be an interesting one because of all the spending from Gen Z.
All right, and we get more economic data, housing starts and building permits.
And you know, the economic surprise index has been trending up. Everything has been coming in better than expected.
Yeah, absolutely here. More Fed speak if you care. Kashkari set to speak. Waller and, of course, our second favorite Bostic in the world. And I'm told there's a big concert tour starting.
That's right. Well, no, resuming. Taylor Swift's Eras Tour returning to the U.S.
All right, stick around. No Taylor Swift coming up, but Joe Matthew and Kaylee Lyons are. This is Bloomberg.